now.
Pension funds, hedge funds, insurance companies, all different bits of private markets. Stuff where regulators don't have a huge amount of visibility on what is going on. Are there risks building up there?
The non-bank financial sector is playing a very important role in terms of providing credit to the real economy, and has also been the source of a number of shocks of different kinds.
Archegos was a classic example of how the rise of vast family offices, hedge funds, sometimes it's actually difficult to tell what they actually are, can feed through to the traditional financial system and cause havoc.
Now, Archegos was this huge family office which borrowed billions from the world's biggest banks and used this leverage to invest in a lot of stocks. These stocks went south very quickly in early 2021. And when that happened, Archegos collapsed and ended up losing the banks in total about $10 billion.
There are allegations there that the general partner involved was complicit or was hiding information from the banks.
Wong and others propped up Archegos as a $36 billion house of cards by lying to banks to obtain additional trading capacity, and then by using that additional capacity to engage in still more manipulative trading.
Because it's all private and not very well disclosed, a bunch of different banks lent more money than they expected to one investor, and the thing they thought they had as collateral turned out to have been used as collateral like 4 places, and to be worth a lot less than they thought. And so the combination is pretty terrible.
Credit Suisse was by far the biggest loser in all of this, though the number of banks spread from Japanese lenders to US lenders, European banks.
Even the supposed well-run experts at Morgan Stanley and UBS, they all took big losses by essentially giving this man the ability to make incredibly leveraged bets on very few stocks, hoping to win big, but in the end blowing himself up and causing a lot of banks to lose big.
Given it was just a hedge fund, the amount of pain it inflicted on the banking sector is actually quite impressive.
This was one rogue person out there. If you had 4 or 5 of those at the same time, then I think that could be a big problem.
It was a warning that we don't have a very good handle on these private funds and investors and institutions that are borrowing privately from lots of different people, and whether their tentacles go back into the banking system and could be destabilizing.
It's in nobody's interest for any kind of shadow bank to get so large and to play around with so much leverage or borrowed money that they end up accidentally breaking a market, whether that is treasuries or gilts or anything else. What we gather from our reporting is that regulators are aware that this is a potential problem, and they are likely to act before something really horrible happens.
Housing affairs will come to order.
2023 obviously was nowhere near on the same kind of global scale that 2008 was. But it was just a reminder that, the post-crisis regulatory framework was put in place for a good reason.
There was a clear lack of regulatory oversight of Silicon Valley Bank, and a situation like this should never really have occurred. Its collapse led to huge shockwaves, not just in Silicon Valley, but ultimately across the US and Europe. However, it didn't lead to the kind of full-on global banking crisis that 3 big banks collapsing in quick succession and others in Europe might have otherwise led to.
If you had said to me at the start of this year, I reckon Credit Suisse is going to disappear and a bunch of banks the size of SocGen or Deutsche are going to go under in the US and it's all going to be fine, I'd have said, look, come on, man, that's just ridiculous. But actually, that's what's happened.
The other side is that the Silicon Valley Bank signature trigger, we clearly had no idea it was coming. We missed it completely. We were looking at something else. So it is a reminder that risk builds up in places where you're not sure. But properly handled, we can slow or stop these kinds of freakouts and prevent them from engulfing the whole financial system.
Does that mean that there is no room to evolve regulation in any way? Of course not. There are always ways perhaps of making regulation more efficient, but making it more efficient is one thing. We should not weaken it.
Don't get me wrong, markets have got a lot of fish to fry at the moment. There's a lot of things going wrong. But the fact that we don't have a full-blown banking crisis that's consumed the entire financial system is genuinely a reason for everyone to pat themselves on the back. This has gone about as well as it could have done. And I do think it's slightly miraculous that we've got to the end of 2023 without a serious disaster having happened.